Today, we will discuss the necessity of an operating agreement in a multi-member limited liability company. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 law degrees and a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my law practice. Our firm website is www.cummings.law. An operating agreement functions as the foundational charter of a multi-member limited liability company, or LLC, dictating the legal, financial, and operational terms under which the entity is managed. It is not merely a formality. It is the single most important document governing how the business allocates profits and losses, manages capital, resolves disputes, and handles changes in ownership. In the absence of a tailored operating agreement, state default rules, often generic and unsuitable, will apply, resulting in unforeseen consequences such as per capita voting, unanimous consent requirements, and tax allocations that do not align with economic intent. The operating agreement must specify each member's ownership interest and how those interests may evolve. This includes documenting initial capital contributions, whether in cash, services, or property, and establishing remedies for failure to contribute in the future. It should also address dilution mechanics for future capital raises, including whether existing members have what are known as preemptive rights and how ownership changes should be calculated. Many businesses fail to specify the treatment of member loans, including repayment priority, accrual of interest, and whether they convert into equity or otherwise affect voting or profit rights. Without these precise provisions, capital calls may be unenforceable or provoke economic disputes. The agreement should also define the process for initiating these capital calls, the consequences of noncompliance, such as forced dilution or buyout, and whether external financing may substitute for member contributions. A well-drafted operating agreement begins by specifying whether the company is member managed or manager managed. This distinction affects decision-making authority, fiduciary liability, and day-to-day operational control. It should delineate what actions require member consent versus what is delegated to managers. Critical decisions such as amending the operating agreement, selling assets, admitting new members, incurring debt, or dissolving the company should have a supermajority or unanimous consent thresholds, while routine decisions may require only a simple majority. Voting rights do not need to track ownership percentage and may instead be tied to units, classes of units, or capital contributions. The agreement must also address deadlocks, particularly in two-owner businesses, with tiebreakers such as independent third-party votes or shotgun buy-sell provisions to prevent paralysis. The agreement must specify how profits and losses are allocated among members, especially when ownership percentages differ from capital contributions. Allocations must comply with the Federal Internal Revenue Code, Subchapter K, and satisfy the so-called substantial economic effect test to be respected by the IRS. Poorly drafted boilerplate language frequently results in phantom income, which arises when members are taxed on income that they did not actually receive. The agreement should include targeted capital accounts, qualified income offsets, and Section 704C provisions for contributed property. Tax distributions must be addressed separately to ensure members receive cash sufficient to pay taxes on allocated income. The agreement should specify the assumed tax rate, timing, and priority of these distributions in relation to operational cash needs. An enforceable operating agreement sets forth internal financial protocols, including the accounting method, fiscal year, signatory authority, and approval thresholds for expenditures. It should mandate the use of separate bank accounts for operating, payroll, and reserve funds. Expense reimbursements, related party transactions, and capital expenditures require clear approval procedures to avoid claims of self dealing in the future. Inspection rights must be clearly defined and limited, allowing members to access books and records without triggering disputes over confidentiality. Trigger-based audit rights, such as upon suspected misconduct, a change of control, or failure to meet certain performance benchmarks, can prevent conflict from escalating. These controls not only deter fraud, but also preserve trust and harmony between the co-owners. A comprehensive agreement anticipates owner departures and sets forth clear buy-sell triggers such as death, disability, divorce, bankruptcy, termination, and third-party sales. It must specify how valuation is determined, how the departing member's interest is funded, for example, by life insurance proceeds, escrowed reserves, or by installment payments, or perhaps some combination thereof, and what closing procedures and timeline will apply. If these mechanisms are absent or only vaguely defined, the business can face costly and time-consuming litigation, predatory fire sale, buyout offers, or operational collapse in extreme cases. Installment terms should include interest rates, collateral provisions, and acceleration clauses in the event of default. The agreement must strike a balance between fairness to the departing or deceased member and the business's continued solvency. The term fair market value is dangerously vague unless accompanied by clear valuation procedures. The agreement should delineate the preferred methodology, whether that's discounted cash flow, EBITDA multiplier, book value, or some other method, and include normalization adjustments, working capital targets, and whether discounts for lack of control or marketability apply. It should also define the process for selecting appraisers, allocating appraisal costs, and resolving discrepancies through mechanisms such as baseball arbitration. These provisions are essential in reducing transaction costs and preventing gridlock when disputes inevitably arise. Transfer restrictions protect the company from involuntary ownership changes. The agreement should require member or manager approval for any transfer of ownership, define permitted transferees, such as family trusts and affiliates, and distinguish between economic interests and full membership rights. Right of first refusal and tag-along, also known as co-sale rights, should be included to prevent stealth transfers. New members should only be admitted through formal joinder agreements that bind them to the existing operating agreement. The creation of new unit classes and anti-dilution protections must also be addressed to prevent unanticipated shifts in control or economic interests. Members and managers may owe fiduciary duties of care and loyalty. The agreement may limit or expand those duties, but must be drafted in compliance with state law. It should outline safe harbors for conflict transactions, such as approval by disinterested members or managers. It should also address the corporate opportunity doctrine, specifying whether members may pursue outside business opportunities and under what conditions. A robust conflict of interest process aligned with indemnification and insurance procedures can mitigate the risk of self-dealing claims in the future. Dispute resolution clauses should require staged escalation, good faith negotiation, mediation, and finally, binding arbitration. If arbitration is utilized, it is necessary to specify the governing body, location, discovery limits, number of arbitrators, and confidentiality requirements. Deadlock clauses are essential in evenly split ownership structures, such as a 50-50 structure, which are generally inadvisable to begin with. And options may include buy-sell mechanisms, third-party determinations, or rotating management authority. Interim remedies, such as temporary managers, status quo injunctions, and escrow arrangements, while complicated, can keep the business operating while these conflicts are addressed. The agreement should also assign ownership of intellectual property created by members or managers and require execution of formal intellectual property assignments. Confidentiality obligations must be enforceable and survive termination. Reasonable restrictive covenants, such as non competes, non solicits, and non interference, must be drafted narrowly to comply with jurisdictional limitations. Overly broad clauses risk invalidation, while narrowly tailored restrictions protect the company's goodwill and trade secrets. In regulated industries such as healthcare, franchising, or financial services, the agreement should include provisions for ownership eligibility, regulatory approvals, third party approvals, and the forced removal of non compliant participants. Multi state operations require specific language assigning responsibility for the all important foreign entity registration, franchise tax filings, composite returns, and other compliance burdens. Failure to assign these roles at the outset often results in penalties and compliance failures, which were easily prevented had appropriate legal counsel been retained at the beginning of the process. The agreement should further specify required insurance types, such as general liability, key person, and D&O insurance, and designate who procures and pays for coverage. Indemnification clauses must define protected persons, exclusions, for example, bad faith acts, and advancement rights. Coordination with state indemnification rules is essential to ensure enforceability. A well drafted indemnity provision combined with adequate insurance can minimize risk exposure for the principals. Further, the agreement should mandate record keeping protocols, periodic financial reporting, and annual meetings. Amendment provisions should be tiered. Unanimous consent should be required for core rights, supermajority for structural changes, and manager level authority may be delegated for mere administrative updates. This stepped protocol creates discipline, increases transparency, and discourages future litigation over ambiguity. A properly drafted operating agreement is not a luxury, it is a necessity. It minimizes risks, maximizes tax efficiency, precludes internal disputes, or at least minimizes them, and protects enterprise value. Businesses that invest in robust agreements up front avoid the far greater costs and uncertainty associated with litigation, regulatory penalties, and failed exits down the road. It is the operating system that governs the legal, financial, and strategic trajectory of the enterprise. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this video is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.